Good morning, ladies and gentlemen, and welcome to the Velocity Composites PLC half-year results presentation. Before we begin, we would like to submit, as usual, the following poll. For your information, throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and we will publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I'd now like to hand over to John Bridges and Andy Beeden from Velocity Composites. Good morning, guys.
Good morning. This is Andy Beeden, the chairman of Velocity Composites PLC. I'm going to take you through the first few slides and then hand over to John. So if we go to slide 2, just to give you an overview of what we're going to discuss today, we've got the highlights of the half year and in fact bringing you up to date. We'll deal with the COVID impact, but then we're going to do a deeper dive into the aerospace industry as we see it now, our extensive business development work, which is in fact, we're very busy in this area, and then a summary and an outlook. So in the last half year, in fact up to today, we've actually been extremely busy in terms of developing the business. And the start of that is we've widened our approvals from Airbus into Boeing. So we've got a Boeing approval for our technology. And that is widening from Europe into Asia as well. And we also have increased our NADCAP score from the standard one up to the merit level. And the merit level is a world-class recognized blue chip award. And again, this plays to our strategy of working with the large tier ones and primes themselves who, aim to operate and have their supply chain operate at that sort of level. We've also done quite a lot of work reorganizing our customer-facing team. This has meant that some people have moved on, and we've brought in a very experienced program director who will run the engineering and business development side of our business with John. And they have 10 years experience working in composite materials for a big supplier into Airbus, and have been working on all the Airbus programs around composites. They know us well. They understand the technology, and they have a lot of key strategic contacts. And again, this strengthens the company as well, and it all fits into our business development strategy. Now, COVID, is challenging for all businesses. For us, it's actually proved a point. As a smaller business in the aerospace industry, you will be challenged over the resilience of your business, compared to very large customers and suppliers. To show you today that we have definitely met that test. We've been hit by quite a significant short-term reduction in demand as customers have simply shut their plants down and now they are reopening them. But we're financially secure, and you'll see that we have £2 million in the bank. We have it today and we had it at the half year. And we also have up to 7 million, if needed, of debt facilities, including an additional 2 million through the government support program, which we'll probably draw down on in July. Costs us nothing, and we expect to pay that back within the next year. It's simply a belt and braces approach in case there is a second wave or some other challenges that come. We don't actually need that extra money today. And a key message around this is, though at the moment there's an artificially low level of production going on within the aerospace industry, and it will, when it recovers, it will not recover initially back to the pre-COVID levels. That will take a couple of years to achieve. We have not lost any contracts. We have not lost any customers. It's simply that those contracts we have today are at a lower level of demand. On top of that, we have a very significant amount of new business in the pipeline, transformational levels of potential new revenues. And again, none of that has stopped either. All those bids continue to progress. And in fact, we always say that it's actually easier to sell our service to a customer that has a burning platform, because they need to do new things. They need to consolidate plants. They need to free up capacity in plants that are being consolidated into, and they're looking actively for cost savings. And these are all the things that Velocity bring with its technology into the industry and into our customer base. So with that, I'm going to pass you on to John, who's going to do a deeper dive in terms of the industry today and also our own strategy and business development.
Thanks, Andy. Good morning, everyone. John Bridges, Chief Exec. So really taking you on to slide 4 there. I think in terms of the COVID impact, a pretty standard response had with most businesses in terms of understanding our demand, taking action to reduce costs, taking action to ensure that our material supply that's incoming was aligned to the reduced demand, and really, understanding the immediate shock to our industry as much as everyone else's industry, and taking the actions to preserve our position and our the balance sheet that we have. As part of that as well, so once we sort of move through the crisis management phase and we've done our scenarios and recognize we have a period of stability and a good horizon in terms of what that means, then we can have started to look at how we actually really capitalize on the sort of disruption as it's created. So, okay, we've got an immediate disruption on our existing business, but in terms of new business, how can we look at really tailoring our proposal to meet the new requirements of our customers as they themselves navigate the effects of COVID-19? So we'll talk about that in a moment around the accelerated customer proposal. So that realignment is pretty much complete. As Andy said, we still have a healthy bid structure and a quantity of bid there that's been worked on or has been submitted. None of those has deteriorated. And now we know that through the modelling that's been done, liquidity is sound. We can really start to look forwards beyond COVID and see how we shape the business and shape the customer proposition to better meet our customer requirements in the new post-COVID era. Onto slide 5, looking at the industry, and again, as it says there in red at the top, any significant decrease in the size of the industry, the current is around 25-30% we're looking at until that 2-year recovery period is significant. But whilst we're in our market share that we are, we still have a huge amount of market to operate in and to bid for. And as we said, no bids have been affected and no current contracts have been affected other than the sort of scale of those contracts. We also starting to see some financial support from the government. So there was the sort of blanket furlough support, which we've utilised. But in terms of the specific industry support, you've seen the sort of recapitalisation of airlines is good. The sort of plans for airlines to get back into flying programs, which is good. And also some more perhaps longer term actions where they've started to retire older aircraft sooner, and certainly their 4-engine aircraft. You've seen a lot of work that's gone on where 747s and even A380s have been retired sooner. So what we're seeing is airlines are reducing their capacity by retiring older platforms quicker. I think as well, what we're also starting to see is as the government support the industry, and particularly airlines, that support always comes with strings attached, and the strings that we're seeing are that the governments are looking for a return in terms of the emissions and the sustainability of the industry as those governments come under pressure from the wider environmental improvements. So again, that's good for us because we operate in the newer side of the aircraft industry, and again, as aircraft get more efficient and are able to travel longer distances, less fuel, less emissions, then that's the key role that composites do play now and will continue to play into the future. And we've made that transition on the twin aisle longer range aircraft, and I think we'll see as well that transition on the single aisle, the shorter range aircraft, will be a composite one as well. So again, we're seeing the capacity mopped up by early retirement, and still a healthy requirement for newer, more efficient aircraft as airlines recover. As Andy said, we're starting to see our customers respond to this change by starting to look at their own industrial footprint, starting to look at consolidation, and again, that's where our services really offer that immediate benefit to customers in that they can outsource a relatively non-value-added activity and free up real floor space that's ideal for new production of flying parts from other sites or other buildings as they consolidate their footprint. So this is what we're starting to see from our customers, and again, we want to play an active part in that consolidation. And that's all been wrapped up really in our accelerated proposal, and this is where we've modified the proposition to customers, particularly around existing bids that are in place, where what we can do is tailor those bids to the sort of post-COVID response, where they need those improvements quicker, easier, with more support from Velocity to implement those changes. And again, that's what our proposal is really offering there, a really much more fully integrated proposal rather than just the ultimate manifestation of supply of kitted raw materials and value-add services. This is a full supply chain optimization service, including the implementation of it. So that's where we see our tailored service really fitting to the needs of the industry. Slide 6, as Andy mentioned, we've started to talk about some of how we're tailoring this to the business development activities, and obviously, as you can see, a lot of this was begun pre-COVID, but it's even more important as we look post-COVID as well. So you can see, as you picture there, it's one of our production areas. It is a very technology-driven manufacturing environment. We're really applying some very proprietary technology that we've developed and integrated ourselves into this huge mathematical puzzle, if you like, of how to turn raw materials into very efficient pre-manufactured kits for our customers. So that technology is really being brought to the fore. So rather than have it behind the scenes, we're now part of our strategic direction of the company, really bringing that proprietary technology to the fore. And actually, it's now an integral part of the sales, not just the nesting software, but all the other elements that have been developed. And we'll talk about that on the next slide. And really, that is because, rather than be seen as a kitting company, as we've done historically, perhaps as we targeted customers at a tactical level, now as we target customers at a more global strategic level, we want to be seen and are seen as this turnkey supply chain partner that is able to look after the whole of that composite raw material supply chain and deliver it into our customers in a lean and efficient way. Key to that, as we've talked previously, is around partnerships. So rather than have to completely develop our own supply chain globally, we can work with partners like Incora in North America, where we can utilize their existing relationships, their existing facilities and infrastructure, and really, bring the composite side of things into their existing hardware, chemical, and other elements of the aerospace supply chain, and utilize that existing infrastructure to deliver our services as well. And that's again something that we continue to develop and continue to look and develop partnerships where we see the benefit. I think we talked about the accelerated proposal and how that works. And then the other piece there in terms of the flexible manufacturing domes is once we've got all the technology, once we've got the bid, once we've got the proposal into customers, clearly then it becomes a deployment activity. And where historically we've looked at opening facilities very close to customers or covering several customers, what the flexible manufacturing dome offers is where we need to really tailor a particular application to even one customer, one large-scale customer, or several customers in a region. What we can do with these flexible manufacturing domes is create that capability at a much lower cost and a much more tailored and flexible way. So we'll talk about that in another slide. But again, having the ability to deploy that technology in a low-cost way, really increase that return on investment, we think is going to be key to us as we start to expand the footprint of the business. One thing we talked about at the half year, which has continued to be developed, albeit it's curtailed a little bit in terms of the physical opening of the facility due to the restrictions and lockdowns, is we have now an advanced technology development centre on site here in Burnley. That is built. It's in the process of being finalised, and that really allows us to develop not only innovative solutions for the now and for current business, but also for future business, and also for the long-term developments required for us to stay relevant in our global industry over the next 20 years. So you'll see on the technology slide in a moment how that's helped to develop some of those technologies, but also how we look to integrate with our customers as they look to things like as we talked about, the single aisle replacement, the ever increasing drive to make composites more efficient and more developed from a manufacturing point of view at our customers, take cost out, but also look at things like some of the more wider activities like Wing of the Future and some of those real structural industrial projects where we need to develop new technologies and new techniques to meet the customer requirement. Page 7 is the summary of the technology. So I think where we've developed this ourselves historically, we've obviously focused on the advanced cloud-based nesting, which is key to certainly the material efficiency side of what we offer. But that's really just part of a much wider system that we've developed called our VRP system. As you can see, that sits in the core of all this and integrates with all these sub-technology areas that have been developed to help us to meet the customer challenge. So clearly, obviously, nesting is important. The actual cutting of materials and preparing of those kits is important there. We have a lot of activity where we take a 3D customer requirement. We have to bring it back into the 2D world to understand how we manufacture it from the 2D raw materials, and then back in the 3D world for the customer use. So we've developed some integrated some existing technology there that looks at scanning 3D assemblies at customer sites, capturing that data really quickly, really accurately, and then bringing it back to the tech center for development. On some of the other projects that we've developed, there's a lot of work that's been performed on the things like welding of polymer films for some of the 3D vacuum bag assemblies that we manufacture, and making that more robust. With the life-sensitive materials that we manage on behalf of customers, we now have a bespoke RFID, the sort of radio frequency identification systems that actually sit on the materials and track their life, their progress, their position, their in the freezer, out the freezer locations, and really manage that for us in an automated way. So we get much better life management of our materials and control of those materials as stock. When we talk about automation in our world, we still relatively utilize the sort of human aspect of the manufacturing of the kits because of the diversity and the complexity of some of the materials. But the way we can add automation is in terms of the inspection and the verification in line with our approvals. So we've done a lot of work looking at automated vision systems to inspect the cut shapes as they're manufactured, to verify that they've been obviously created correctly and found themselves into the correct kit. And all that's done automatically and verified, ready for incorporation into our certificate of conformity onto customers. Linked to that is another system we've developed for verifying processes. So certain customer wanted a certain process verified. So rather than do that manually, we can develop these existing technology that's out there on vision systems and integrate them into our system to really make sure that we're staying at the leading edge of where the technology needs to be to help us to do what we need to do. And then, of course, demand management, tracking, traceability is built into the system, and then linked with the ability to deploy that through the flexible manufacturing systems, be very close to customers in a low-cost way. Again, both ourselves and our customers see a really powerful proposition that's a long way ahead of where they are, and also realistically, for them to invest in this to this level individually, it doesn't make any business sense. They're starting to understand, and by working with us, see the real benefit of this technology, and seeing it deployed across their businesses worldwide. Is much more cost effective than having to start and develop it all themselves, because clearly it's not available off the shelf. Page 8, really just an update on our US opportunity. So as previously announced, we have a partner in North America. Used to be called Wesco. They've now merged with another company called Pattanair and are known collectively as Incora. It's a much larger organization. Composites is a very significant part of their growth ambitions as well, working with us. So again, we've continued as much as we can through the restrictions to progress the opportunities in North America with them. We'll be picking those up, obviously, again, as restrictions are lifted, but nothing's changed there in terms of the bids that we have in play at the moment. We will be opening a facility in the Atlanta region. Those bids incorporate a flexible manufacturing system, which you can see there in the picture. And again, it's perfect for what we need. These are 20+ year warranted structures, very low cost. But for us, what we need is a very controlled environment, and this is exactly what these need. There, a lot of air management in these structures. It's filtered, it's environmentally controlled, it's particle controlled. It's exactly the same environment we need, and we see a real benefit of deploying these very close to customers and offering a very bespoke service free of logistical headaches. On page 9 is a similar update for Europe. So again, you can see the sort of people we're working with in the addressable market. Really a three-pronged type of approach in Europe, mainly direct rather than with partners, but we do have some partnership work in Europe. But essentially here it's about continuing with the live bids that we already have and the bids that have already been submitted and progressing those through now with the accelerated proposal. And they're with existing customers where we're completing the remaining projects on a particular site or other sites in their portfolio in Europe where you can offer a sort of a fully regional proposal. Secondly to that is targeting more direct work with the key OEM in Europe, which is of course Airbus. So again, the changes that we've made with the customer programs director and the refocusing of that team really helps to improve the direct relationship with Airbus and its direct supply chain, because that's where a lot of the business is, certainly in composites in Europe, and understanding and being an integral part of that supply chain is key to our growth. And then the third piece of the European opportunity we see now, certainly post-COVID, is we're heavily focused on the civil market. However, there is also a large military market which is less affected by things like COVID. So again, we've got a strategic approach there, particularly around the F-35 supply chain and some existing customers in the regions that we already have facilities to really target that supply chain at a much more strategic level and offer that particular customer and customers a tailored approach with military to try and improve and increase the amount of military business within Velocity. Page 10 is our financial summary, and Andy, would you like to take us through that?
Yes, thank you, John. So if we go back to when COVID impacted the supply chain, it started to really impact in March and then very significantly in April. And the initial impact is that most factories and facilities went through a period of shutdown and then reopened at lower levels. And some then went into secondary shutdowns as they cleared down inventories and awaited what the new norms may be. So you had significant disruption March, April, May, and June. And as we come now out of June, we're seeing nearly all customers opening up their facilities. So as I said, we've not lost any contracts, but therefore the volumes being taken by those customers was significantly curtailed at the end of the half year and then into the second half of this year. And you can see that reflected in the revenues. And before that impact, we were on target to be similar year on year, probably with a better gross margin year on year. And the gross margin now has been slightly impacted by the fact that you carry fixed costs through the factory, which no longer get covered by the sales margins. But we're not significantly behind last year on that gross margin, and that simply reflects the fact that we would have been ahead of it, strategically. And in just talking about our gross margin, the new business that we're working on and the way we're selling that enables us to ultimately widen that margin, because we're getting better value for the full technology and services going forward. And that is one of our strategic objectives. The impact, therefore, of the lower revenue is a small operating loss and also a small EBITDA loss compared to where we would have expected to have been. And that, again, is an artificial position, really, and will be in the second half of this year. And more importantly for ourselves and yourselves as investors, is what will be the new norm? What will we get back to? And the expectation at the moment is that within 12 months, the market may settle down at 25% contraction, which for a big company, our large customers, is a huge headache, and they have to consolidate sites and make major restructuring. For ourselves, which, as you've seen, we're only just penetrating the market, and we have significant new bids ongoing, which are transformational, we can live with that. That won't affect the long-term strategic direction of this company. We have to start a little bit behind where we were, and that's frustrating, but it will not affect the long-term drive for this company and its value longer term. And just to reiterate, really, we had 2 million in the bank, plus the ability to draw down on up to 7 million in debt. We don't need that 7 million. You can see that, but it is there, I guess, as a backup. And the invoice discounting facility is there to manage growth rather than anything else. And the government support is there to underpin the costs of the lockdown, and also, given we didn't actually need it initially, it's there as a belt and braces in case there is that second wave and a real unexpected second lockdown. So I'll pass you back to John to do a sum up, and then we'll move on to the questions.
Thanks, Andy. So on page 11, as you can see there, I think, unplanned, of course, and unwelcome, but we've had to demonstrate, and with all the work we've done through COVID, this very resilient model and the robust financial liquidity position, and also make sure and demonstrate and be very, very comfortable around the ability to withstand the recovery scenarios, because the recovery, of course, is respected. We're planning for that, but we want to make sure that the company's capitalised accordingly. We have this strong pipeline, circa 30 million at the moment, which we continue to progress. Some of those have been bid, or in bid, or are planned bids, and responses to RFQs from new and existing customers, and we'll continue to work through those as we move through this recovery period. We've strengthened the business development team, which is key, and obviously refined the pitch in light of COVID to really tailor that now to the exact requirements of customers as they come through this period, and really make it much easier and quicker for them to adopt the services of Velocity as they need to transition themselves. And again, that's possible because of all the work we've done prior to COVID strategically, but also the changes we made in the teams, and the changes we've made to the customer engagement processes, which allow us to really tailor this now and get actively involved in our customers' recovery and restructuring processes, and give them the savings that they need now in a much more immediate way. The partnership with Incora in the US is obviously progressing very well. A lot of activity there, and the primary bid includes the deployment of a flexible manufacturing system. So again, once that's live in that particular part of the world, we expect that the ability to demonstrate that locally to have a very positive effect with other customers when they can see it in action and the benefits that it brings. The leadership changes in the business have been very beneficial in terms of the strategic changes we made prior to COVID and managing through the COVID process, and that's both at the non-exec level and also the exec level. And now we have a very good focused team, awful lot of commercial experience, financial experience, but also key aerospace experience and composite experience. So certainly I feel now we've got a much more balanced and capable team with the experience needed to move into the sort of next phase of growth. And with the technology that we've developed to deliver this, we're wrapping that up within our Advanced Technology Centre to really get involved in solving our customers' current problems and developing solutions to suit, but also being involved in the longer term evolution of the industry and making sure that we have the key technology of products and processes to enable us to offer our services, not just now in the next 5 years, but also 20 years as the industry moves to this low emission, lightweight, composite aircraft structures. And then finally, if we could summarize all that in 2 sentences almost, I think clearly, as with everyone, the trajectory has been affected by the disruption, but the opportunities certainly haven't diminished. The proposition that we have, we feel, is even more relevant now, and we're getting some very positive response from customers as we start to roll that out. And we want to make sure that we're set up not only for the new training environment now with customers, but also the expected growth period once the industry recovers and moves to this lightweight, low emission phase.
Brilliant. Thank you very much, John. Thank you very much, Andy. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to receive those investor questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Before we just go into the Q&A, I'd also like to remind all investors that your feedback is very important to the company. Immediately after this presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. John, Andy, obviously investors had the opportunity to submit questions pre the event, and we received a couple, which if I could start with those, and then perhaps if I could ask you then to address those that have been submitted today, and just remind you if you could tell us either who they're from and particularly read the question so everybody can then address your response. And of course, I know you can only answer so many questions within the remits of what is in the public domain. John, Andy, the first question that we had pre-submitted by an investor was, can you elaborate on the Incora partnership and Velocity's freedom to operate in North America? Are there any exclusivity rights incorporated into that agreement between the two parties?
Yes, so we have an exclusive partnership with Incora in North America, and it's expandable to other territories if we both see benefit, but it's really focused around North America and the significant customer base that operates there.
Thank you very much indeed. The follow-up question submitted was, what efforts are being put into diversification from aerospace and conventional aircraft? The automotive, drone taxi sector both seem likely candidates for Velocity services. Do these form part of the identified growth strategic plan?
Yeah, so I think we talked briefly about the sort of civil side and military side. So I think military is a focus in terms of a sort of diversification. One of the constraints we do have is that certainly in terms of our approvals and the specifications we adhere to, it's pretty much aimed at aerospace composites. So, things like automotive would not be seen to be too there are risks of operating both automotive grade materials and aerospace materials and processes in the same building. So we'd have to look at that. But in terms of things like UAVs, that is something that's active. There are some customers who are working in both civil aerospace and UAVs. So it's very similar from that respect. A little bit more consideration if you were to look at automotive, but I think the other thing to bear in mind is the value. I think we see aerospace is where the value is, and there's much lower value materials that are used in automotive. So I think it would have to be separate, but it's we are really focused around things that fly at the moment.
Brilliant. Thank you very much for that. So obviously, if we can then just move on to those questions that have been submitted today. Obviously, if I leave it to you guys to address those ones where appropriate. And as I said, if you could read the question, that'd be very useful, and perhaps who it's from.
Okay. Well, I'll. The first question is quite a long one, so what I'll do is I'll summarise. It's from Alex R, and really it's asking what has changed now from, say, the last 2 or 3 years, where the company had flatlined in its revenue, but had expectations of growth. And so the essence of this question is around what has changed in terms of getting opportunities over the line versus maybe looking back the last few years. And I think, John, you probably could very easily answer that question now, given your presentation.
Yeah. So I think in terms of the growth drivers are certainly the same. We've looked at how we engage with customers and where we've tried to engage at being the size that we are and were. I think previously there was a real engagement at the lower levels coming in at site-based level, whereas now, and we talked about it at the sort of full year as well, we're engaged on a smaller number of larger projects, albeit at a much more strategic level. So that's certainly a completely different strategic approach, based on the work that was done certainly last year with the exec and the board.
Yeah, absolutely. I think that's the key. That the opportunity for growth is clearly been there for a number of years. I think it's the way we now engage with the customer at the right level. So with a number of key customers that we already sell to at a business unit level, we're now engaged with people who work at a strategic level, and they are empowered to look across their whole business and look at us from a strategic perspective, and then push that back down into opportunities, some we've worked with before, and others that in fact opening up and doing a cut and paste of what we do across their facilities. And likely we have to be able to react to that on a global basis, hence our flexible manufacturing solution. So there's been a couple of questions that were, I would say, asking us about our USP, and I think we've answered that now. They came in earlier on the presentation, so I don't see any need to go through that again. There's been a question. There was a question also on what we saw around expanding in the US, and would acquisitions help accelerate this? And the answer is we wouldn't see the need for an acquisition. We have a partnership with Incora, who are on the ground in the US, a major facilities provider there. And we wouldn't need to invest in our dome structures across the US as we win business, but we wouldn't see the need for an acquisition, because we've both got our own networks and also the support of Incora. So I think that's the answer to that one. In terms of the next question, which comes from Robert M, is what is the outlook for Capex and again the cost maybe of expansion in the US? Well, just currently we've obviously done a freeze on any non-essential Capex to retain cash, but we have already costed the initial first phase of expansion into the US and a phase into Europe, and that's all covered by the current EIS funds that were raised at the IPO. If we then go into a second phase, then we do have the invoice discounting solution, which can help fund that. And we could look, if we had a very significant demand for Capex, at raising equity. And we also should point out that the solutions that we've developed are actually far lower Capex intensive than just putting up your traditional facilities on the ground across a new region. And they are able to be deployed on winning a contract. And in fact, we include within the contract the costings for putting in those facilities. The next question is it's from Craig P, and it is about the government aid. And it asks, what are the figures and shown? And it says, if not, what would the results look like? So I think that's really just, I suspect that's a question about what the aid has been for Velocity rather than the industry. And as we said, we have furloughed, it is the predominantly lower paid manufacturing operators, but we have furloughed about 60% of our staff, and that probably gives us a benefit of several $100,000 a month while we do that. And then the next question is from Alex R, and it's about the 30 million pipeline, and is this the annual contract value or the total contract value? And it is the annual contract value. So, you know, that when we quote those contract values in that way, we're talking about the potential for an annualized amount. And often the contracts come with an LTA, which is usually between 2 and 5 years in length. The next question is from Alex R, and it says, again, can you run through the Capex working capital requirements, onboarding new business? Well, John, do you want to maybe elaborate, say, on the US first stage opportunity, just to explain maybe some of the costings around that? But what I would say is that winning business in the UK clearly just fills the current capacity of the current plants, and therefore there is no extra Capex. And you know, it's covered by we're able to fund that through discounting the invoices. But there's a relevant question if you move into new territories. So, John, maybe to highlight, you know, how you see that initial implementation in the States.
Sure, yeah. And I think it also answers Alex R's next question. So in terms of the Capex, that initial inquiry has been supported from the UK, from Velocity's point of view, and obviously Incora have their local teams. The Capex really just covers the phase of the engineering creation of that bid. So again, if those familiar with the company will know that we don't very rarely get very refined RFQs. It's more of an engagement with the customer to understand the current state, and then determine a future state and a complete supply chain solution, and then, you know, bid at that level. So there's a lot of engineering work from our business development teams to come up with that and to understand how we would supply them. And you know, you're almost having to create the service before you can bid it, because of you understanding, you know, the nesting scenarios, the materials, the costs, etc. In terms of Capex already spent in North America, we have some spend already on some of the long lead time equipment, so some of the cutting machines, and other than that, really it's about building the teams. You know, have a full implementation plan on how we would, you know, recruit and train the people, supported from Europe initially on the first opportunity to get that flexible manufacturing centre set up, and up to speed with all the training requirements and the people requirements. And I think the next point from Alex R around your main competitors, I think this covers that. The main competitor for us, and in that example and all the other examples, is this work is currently performed by our customers themselves, and it's really about helping that particular customer and all customers to outsource this in a way that they've never done before. It's always lived within their facility, and now, just as the industry and their requirements have grown, it's about being able to offer to them a complete service that's better, that's more utilizing all this technology to take out the waste, the cost, the risk in terms of managing these materials and providing a really lean and efficient service that's pre-manufactured and delivered right to the line side. So in terms of our main competitor, it's our customers themselves, and some of the challenges we've faced has been helping our customer to understand their current costs, because it spans many departments internally, and lots of things are lost in areas like overhead. So part of the accelerated proposal is to really perform not just the engineering work and come up with the price for the service, but also help customers to realize what that means in terms of their current costs and the total savings and the sort of total cost of ownership of this part of the supply chain, and how much it's transformed by moving to velocity, and all those costs are realized. So that that's where a lot of work's gone on. That's where a lot of work continues, and really helping our customers, who are our competitors, to become very content with a complete outsourced solution. And then obviously now in this environment, it's about doing it in relatively short order now, because of the immediate need to take that cost out and to free up capacity and space to do other things.
And so the next question, which is Ali S. Thank you for the presentation. Can you explain the gross margins at circa 20% for a high value added company? So one of the reasons for that is that there are two key points. One, we do have a strategy to improve our gross margin, and you can see in the way that we now are selling our services and technology, it's moved from being someone who can cut out parts for a customer to someone who supplies a full solution in the supply chain, and we would expect that to improve our margins. So some of this is historical. The second factor is that one of the primary elements that we are buying and selling, and therefore preparing the material for our customers, is expensive composite materials, and their cost is a pass-through in our business, and that does mean that the margin is that cost is passing through the P&L and the cost of sales. If we work on what we call process or consumable materials, that margin is very significantly higher, because the value of the material is a lot less versus the added value that we charge. And then the next question is basically, how do we split the revenue between ongoing customers and ad hoc revenue? We have very, very little ad hoc revenue. So all our revenue really is for ongoing customers. We will have a little bit of revenue in this second half year, which is actually manufacturing PPE, and we're using our cutting machines to help NHS suppliers. But that is fairly small, and obviously is ad hoc. But the rest of our revenues really are repeating long-term revenues from long-term contracts, and more importantly, long-term relationships. John, would you want to add to that, or?
Yeah, totally agree, Andy. It's very little is ad hoc. It's all it all has to be very long-term, all contractually agreed. The materials all flow down. It's all global flow down pricing, and so there isn't a very strong long-term element to it, not only on the material and the pricing, but also the fact that, as we're saying, this is work that's transferred from our customers. It's done in a very controlled way, and so any transfer out of customers takes time and is very carefully managed. And so, one of the parts of that customer relationship is the fact that we work very closely, because it's very difficult to move this from our facility as well. So we want to make sure that we build very strong long-term strategic relationships with customers and continue to offer them high levels of value and incredible service levels.
Thank you. John, Andy, I think just monitoring the questions, I think you've given everybody a response to those questions that have been submitted today. I don't know if you just want to have a quick wrap up and then hand back to me, so I can obviously redirect investors for the ability to give you feedback.
Okay, thanks. Well, thank you all today listening and asking the questions. Recognize, as investors, these are difficult and challenging times, but the message from the board and its management for Velocity is we did the quick things, the things that needed to be done in terms of protecting the business and the investment. We can flex our cost base and will, if needed, to adapt to a lower, shorter term revenue and demand. But the business case for long-term investment and growth remains. And all the work we've done in the last 12 months, wrapping it up into a technology solution, pushing that out to customers at the right strategic level, building up that network across the industry, getting Airbus and Boeing to know who we are and actually being advocates of us, as well as building relationships with the big suppliers in the composite industry and getting those new qualifications in place. This is all major progress that we feel will still yield significant benefits for investors and the company in the next 12 to 2 years, 12 months to 2 years. So I thank you all. I thank John for your presentation and going into the new technology and everything. And we will speak to you next time.
Thank you very much, John. Thanks, Andy. And thank you really for giving all investors the opportunity to become part of your investor roadshow around these results. Could I ask investors please not to close the session, as you will now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, you will be automatically directed. If you entered this through the link in the email, you'll be asked just simply to log in and then present your feedback to the company. Once again, thank you very much, everybody, for attending today. That now concludes today's presentation. Thank you once again.